For more on the markets, let's now speak with Diana Avigdor. She is Vice President and Head of Trading with Toronto-based Barometer Capital. And also in New York, we've got Doreen Mogavera. She's Director of Business Development and Institutional Trader at O'Neill Securities. Good to have both of you with us today. And Diana, let me start with you because I want to hear from you why we are seeing such a surge on the TSX today.
Central banks are telling you that we're going to do everything we can in order to support an economy that if you are in the camp that it's faltering, we're going to make sure that we make it as possible for you to do business or to buy a house or to get a loan within reason. The oil, the commodity sell-off has hurt Canadian economy, and I guess they felt that this was necessary. The expectation that this was going to happen today, the rate cut that is, it's not a surprise in a cut, it's a surprise in the timing. And perhaps since Bank of Canada decided not to give forward guidance anymore, this was better sooner rather than later if it was going to happen anyway, in order to give a boost to perhaps the exporters or to the housing market or to the loan market. To offset some of the energy weakness that we've experienced.
Diana, should our investors, our viewers at home, start to kind of think about what we've learned from the Fed over the past 5 years and the impact that they've had on their equity markets, which is it's always been don't fight the Fed. We've rolled that out to don't fight central bankers, basically in Europe as well as China. Do we need to bring that back home and say don't fight the Bank of Canada, and that the TSX, our Canadian markets, are going to continue to rally on the back of this new norm almost?
I think that what happens in Canada, first of all, I'm going to agree with you, do not fight the Fed. You see what's going on in Europe, actually. The equity markets, Germany, for example, is making a new high, is positive actually, and making a new 52-week high in local currency. But also, if you bring it back to US dollars, is actually positive on the year. Energy is a big portion of the Canadian economy, but we're also exporters. And with a weaker Canadian dollar, I think that our Bank of Canada is hoping to offset those negative influences. We have a housing market that has not corrected.
Right.
That is, perhaps we are not in the same place in the cycle from that perspective. And that is a big sector because people own their homes. It makes them feel comfortable or richer or poorer.
Right.
So we have not corrected
Doreen,
in that perspective. So
yeah, Doreen, I want to bring you into the conversation as well. It's not quite often
Sure.
that the governor of the Bank of Canada might be on your radar screen sitting in New York City, but where were we today in your minds?
Well, I think that, so much of the world is facing the same sort of issues that Canada is right now. We've only faced them a little bit ahead of time. Oil has been the impetus for your rate cut, but I think, shoring up economies and Fed policy has been going on globally. And I mean, I'm sorry to see that Canada has to join those ranks, but I think that it's important to know for all of our economies that the Fed is there for us and all the central banks are there to shore us up. I mean, I believe, as you know, Catherine, that much of this rally is due to the fact that we've had a very friendly monetary policy to stocks.
Right, and I guess the question now is, what in part will we see from the ECB tomorrow? And then on the back of that, what will the Fed do? Doreen, what do you think the Fed will do? If you've got every other central banker in the world essentially lowering their rates, reducing the value of their currency, what can the Fed do now? And I'm asking that because that will impact, you think, the U.S. equity markets.
Right. Well, I think that the Fed, I don't think rates here are going to go down. I think rates are going to stay stable to going up. Going up is the question, when are they going to go higher? And that's what everybody is really sort of betting against or on. As you know, obviously higher rates are not good for the stock market in general. So I think the U.S. Fed right now is probably going to stand pat until they see a little bit more into this first half of the year. I think the volatility that we've seen obviously is showing that there's a lot of uncertainty. Certainly there are a lot of geopolitical headwaves that we have to follow, and I think that I think really we have to see a little bit bit more in terms of direction for the Fed to make a move right now.
Fair point. One of the directions, though, that we are seeing in the market today is some stabilization in the energy stocks and the price of oil. It sounds as though BHP pulling back their investments in the U.S. shale play is really helping to stabilize oil and therefore the supply in the U.S. shale. The big question, though, for everybody right now is, have we seen the bottom? Diana, what do you think here?
It does not look like we've seen the bottom. You know, Catherine, we wait for the turn. There is a lot of supply out there, and there is a lot of unwinding of positions, and we still have to see these energy companies' earnings. So I don't feel that you have to step in at the moment.
Fair point, Diana, though. Let me ask you as well, though, how much pain was felt in the market today from your assessment because this was such a surprise move by the Bank of Canada?
Are you asking in the Canadian market?
Yeah, in the Canadian market.
0 out of 36 polled have expected this move today.
Okay.
The markets have started, TSX, talking to traders yesterday already, started to be very busy. It is very busy today as well. And energy obviously is lots of short covering, lots of trading, lots of positioning, but also in all sectors, in the financials, it's split half-half as to whoever believes that this actually benefits the financials versus does not benefit the financials in terms of margins. There's so many moving parts.
So many.
Spurring loan growth and so forth.
Yeah, so many moving parts. One of them, of course, will be the ECB tomorrow. Doreen, are we set up for...
Yes.
Are our expectations set up correctly? What do you think?
Well, I mean, I've heard numbers anywhere from $500 billion to, $1 trillion is expected. So I've heard traders say that $500 billion is not going to make the markets happy, and $1 trillion will make them, elated. So, I mean, I think we really have to see where we fall. I think this is kind of a wild card today. And you see the volatility here, so obviously lots of people betting in different directions.
You really do. All right. Thank you, both of you, very much for joining us today. A lot to discuss.
Thank you.
That was Diana Avigdor. She's
much.
Vice President, Head of Trading at Barometer Capital Management, and also Doreen Mogavera, Director of Business Development and Institutional Trader at O'Neill Securities.